The persistent rise in the 2 to 10-year Treasury note yields have made preferred stocks even less attractive to me. My primary objectives are capital preservation and income generation. I have been paring my preferred stock allocation and will discuss the sales that I made yesterday in my next blog post. Since the Fed cut the federal funds rate by 50 basis points in September, the 10-year Treasury yield has risen by more than 100 basis points. The subject of this video is closed-end funds, abbreviated in this video to just CEFs, that own preferred stocks and some bonds, mostly if not entirely exchange-traded bonds that I refer to as baby bonds. Most of them have $25 par values. Exchange traded in this context simply means that the bonds trade like stocks on the stock exchange. Many of these funds use leverage to buy some of the securities that they own. For those using leverage, most will borrow money at spreads to short-term rates, and depending on the fund, the leverage will generally be in the 20 to 40% of asset range. And this needs to be looked at by anyone considering their purchase. And also, it is important to look at the last semi-annual or annual report to see how much money the fund is borrowing and at what cost. For those unfamiliar with closed-end funds, I would recommend reading some information provided about them at the CEFConnect.com, all those letters together, which is a website run by the Naveen Investment Management Company, or the Closed-End Association's website, which can be found at CEFA.com. Most investors are familiar with mutual funds. You send them money and shares are purchased at whatever the fund's net asset value happens to be at the close on the day the money is received. Though if you're purchasing them online, the order to buy or sell has to be entered before the market closes in order to get the closing price. That is called an open-end fund. There is no fixed number of shares. The assets under management will fluctuate day to day based on net purchases or net sales. The closed-end fund trades like a stock on the stock exchange. The capitalization is not open but fixed based on the proceeds received from the original IPO, with some funds supplementing capital with subsequent stock offerings like any corporation might do to raise additional funds. The price paid for a CEF share is not based on the net asset value per share like a mutual fund, but on whatever a willing buyer and seller are willing to accept, which in most cases, but not all, is a discounted price to net asset value per share. In some cases, the fund shares may, for a time, sell at a premium to net asset value per share. This type of ownership has been around for over 100 years. I invested in my first CEF in 1984, buying shares in what was then called Adams Express Company and has now been renamed to Adams Diversified with the same ADX symbol. The fund was formed shortly before the 1929 stock market crash and survived. A few other stock CEFs that I've owned and currently own were formed prior to the October 1929 crash and have survived to this day. Most of them, which used a lot of leverage, were bankrupted pretty quickly after that crash and the ensuing depression. They were gone by 1932. The preferred stock ETFs are a more recent vintage. They are uh, several of them can be bought and sold on the stock exchange in the same way you would buy an individual common or preferred stock. I will use one of these funds as just an example. This one is that I'm going to talk about is called the First Trust Intermediate Duration Preferred and Income Fund that trades under the FPF symbol. I will be using Morningstar performance data, which can be reviewed on its website. Just enter the symbol FPF in the box at the top and then click Performance tab. Using data from January 7th, 2024, FPF closed at $18.03 with a net asset value per share of $19.23, creating a discount using those numbers of minus 6.24%. The fund uses leverage. The fund currently pays a monthly dividend of 0.1375 per share or $1.65 per share annually at a total cost of $18.03, yesterday's closing price. The dividend yield would be about 9.15%, which sounds good until you actually start looking at the historical total return numbers. At the fund's website, you can find the tax classifications for the prior year dividends. The information is listed on the IRS Form 8937 and the 2023 tax reporting data that the fund provides under its News and Literature tab at the fund sponsor's website, with the latter only available for download in the XLS format. I will look at this data to see how much of the dividend is classified as a return of capital and how much is classified as qualified dividends. In 2023, this fund paid a total annual out of the total annual dividend paid by this fund, the return of capital part of that dividend was 0.210499, classified as return of capital, which reduces the tax cost basis by that amount, but is not taxed until the shares are sold. Of the total taxable dividend of $1.35 plus cents, which excludes the rock sourcing, $1.14 plus cents per share was classified as qualified. So that tells me that this fund has a significant weighting in bank holding company preferred stocks that pay qualified dividends without looking at the holdings. The weighting in bank preferred stocks was last reported at 47.4%. This CEF and others are as well that invest in preferred stocks and to some extent baby bonds have gone down in price as interest rates started to rise in 2022. The decline in net asset value will be increased some by borrowing money to buy securities that go down in price, which doesn't require a Nobel Prize in economics to figure out. In addition, the cost of borrowed money was going up during this period prior to the Fed rate cuts. For the fiscal year ending October 31, 2024, the fund used reverse repurchase agreements for leverage, and the weighted average cost was 6.03%, but had fallen to 5.46% as of 10/31/24 in response to the Fed rate cuts. It would have trended down since then. While FPF would have a higher dividend yield than non-leveraged preferred stock ETFs, like the one I discussed in an earlier video, PGX, the price decline would be more severe during a period of rising interest rates. The 1-year annual total return of FPF through 1/7/2024 using Morningstar data was 17.54% using price rather than net asset value, which will change the numbers only slightly for a fund, which is better than the preferred stock ETFs that do not use leverage. Notwithstanding the better 1-year performance, the hit taken in 2022, when the total return was minus 25.45%, was significantly worse than the decline of the PGX ETF, which is unlevered. The poor performance in 2022 reduced the FPF 3-year annual average total return, which includes dividends reinvested, to a minus 1.59%, wiping out the 1-year gain of 7.54% and then some. The total return was plus 2.46% over 5 years. And when you hold this security in a taxable account, you got to pay taxes on the dividends. You might have to pay, if you live in a state with the taxes, dividends, you would have to pay the state tax, and then you would need to make also an adjustment for inflation to figure out what the total return adjusted for inflation and after tax would be. And without actually doing the calculation, it is easy to see that this would be a negative real return over the last 5 years. So these leveraged preferred stock CEFs need to be avoided as long-term holds, in my opinion, or some kind of trading system used to move in and out, selling the rips, buying the dips. What I try to do. Another risk mitigation technique for leverage funds that I will use is just to keep my dollar exposure extremely low and insignificant to me. For FPF, I may generally own anywhere from 0 to 150 shares. The maximum limit is arrived at by assessing risk to total returns, which are significant for these kind of funds, and to examine the risk in the context of my financial goals and risk tolerances. A long-term hold over 10 years would have produced an average total return of 6.09% before applicable federal and state taxes when held in a taxable account and prior to any adjustment, a downward adjustment to account for inflation. I did not do this calculation, but given the high inflation numbers of recent years and assuming a 35% blended marginal tax rate that includes state and federal taxes combined, the after-tax inflation-adjusted total return over the 10-year period would likely be maybe slightly negative and definitely negative over the past 3 and 5 years. The positive return that, based on the Morningstar data that is provided, would only be for the recent 1-year period that Morningstar covers. I suspect that many individual investors look at the dividend yield of this type of security and see only a shiny object without delving into an analysis of the total return that takes into account price fluctuations after purchase and over longer periods than a few days or months or even a year. And I'm talking there about 3, 5, or 10 years when assessing whether this security is a long-term hold or at best a trading vehicle. For leveraged equity preferred stock funds, the analysis needs to include until you conclude it, an understanding of how preferred stocks react to changes in interest rates, the potential risk and benefits of using leverage, and how preferred stocks, equity capital, junior to all bonds in the capital structure, will respond to worsening economic conditions. And there is a lot of recent history on how they responded to worsening economic conditions. I mean, going back to 2008 and 2009, or even just back to the pandemic period that we had in 20, a few years ago. So those risks need to be understood before investing in these kind of securities.